Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for December 7th of 2025. As we get a little bit closer to the end of the year here, we're going to talk about a few different things. On this slide, we have the hard data versus soft data. And so this is something I've been talking about a lot this year. And soft data represents surveys and kind of statements of opinion as opposed to the hard data, which is the actual data that you see for factory orders, that you see for shipments and production and those types of things. So, I mean, this is data that is readily observable. And so I think the key takeaway from this is that the hard data, the demonstrated performance in the economy has been much better than the perception of it. And as you can see here, hard data represented in the black. This is economic surprises as we've kind of transitioned throughout the year. So these economic surprises in the hard data, in the actual data, have been better than expected and have become increasingly so. And so this has led to kind of a surge in relative confidence as a matter of course. Now on the flip side here, we have soft data, which represents the surveys, and those continue to get weaker. So when you think about consumer sentiment and things like that, which has been notably weak, and we've talked about this K-shaped economy, and so the surveys that really kind of tap into the income levels and the income cohorts here, those have not been particularly good, except for the upper income ones. But here you can see a clear divergence that we're getting a lot of positive surprises here in the hard data. Now, if we go over here by growth by indicators, so here again, it's being supported in the actual data that we're seeing. We've got basically around 2% growth for the balance of the year, whereas that soft data would have told you or would have foreshadowed something much lower than that. So hard data is supporting the growth, and I think as we see in the ensuing charts here, it's fueling more optimism, earnings growth, and projections for next year, so on and so forth. So on the heels of that optimism that I was just talking about, you can see here very clearly, you look at the Bloomberg consensus estimates for the 4-quarter ahead economic growth forecast. And you can see, as we kind of trough here during the tariff tantrum, that those numbers have been coming up throughout the year. And as we sit here in December, we're looking at something that is, something closer to about 1.75. Again, that's not overly stellar, but it's obviously better than where we were. The tariffs and maybe arguably lower than where we were perhaps towards the end of last year. But again, it's an improvement. The sentiment is there from a kind of a macroeconomic standpoint is there, even if some of those sentiment surveys of consumers are not nearly as strong. For the record here, Goldman has an even more robust forecast. And again, I think the takeaway here is the linear direction in which these are all moving higher. So we're starting to get some feedback now as people are analyzing the one big beautiful bill here. And so this is just one chart by Apollo that gives an opinion, but I'm reading this in all of the work that's being put out on Wall Street now. I mean, they're all able to begin quantifying the impact of this. And so, we're really looking in 2026 as something, by this estimate, again, this is one investment firm, about 0.9% of economic growth being attributed directly to the OBBBA. Now, 2034, when you get down, several more years down the road, expected to still be positive, but again, in legislative, horizons, this is an absolute eternity. When you talk about election cycles and even presidential cycles, that obviously a lot could change between now and then. But really, the key focus and the purpose of putting this slide in the deck this week is to say that whether or not you believe 0.9%, there is very arguably a positive impact from OBBBA next year, notwithstanding all of the fiscal impact and the debt and deficits and so on and so forth. at least from an economic growth standpoint, there is pretty broad consensus that it's going to be positive. So something I just wanted to show, we've got two charts in here that go back way back, 1870. And so when we think about economic growth on an annual basis, and sometimes we get caught up in the microcosmic changes one year to the next. And, if we think about, like, again, investors with long-term horizons, and I'm not saying that, we're talking to people that are, were born in 1870, but I mean, with some rare notable hiccups, Great Depression, World War II, and you had the tech bubble here, where it kind of deviates from this, essentially almost 2% trend line in economic growth, that you can see that it has a very strong line of best fit here. And so, again, long-term horizons, you just plow through the noise. And you could argue that maybe we're trailing that 1.9 here over some of the growth that we posted most recently, inclusive of the pandemic. But again, it fits that line pretty neatly and it has some predictability to it. So now, a quick mention on retail sales. Again, much stronger than one would expect, and I do think the wealth effect is at play here. As we'll see, the upper income cohorts, have much more of their wealth tied up in stocks and perhaps more liquid investments, and they certainly have plenty of cash on the sidelines. So again, as we transition through 2024, 2025, we're seeing really strong relative data coming out of retail sales, and then the Red Book Index is essentially another proxy for that. Now we have core personal consumption expenditures inflation. So this is core PCE inflation. And again, another reason for optimism here is because not only do you have a little bit of a downtick here, so this is represent actual data, and again, we're catching up here a little bit because of the shutdown. But maybe we get a little bit of bump in January, but the directional focus of this throughout 2026 is expected to move down. And so that's giving people a lot more confidence in their estimates and their forecasting in terms of the potential for economic growth. I think all these charts kind of have a kind of a broader economic sentiment profile to them. Next slide here represents company profit expectations both in 2025 and 2026. And this, again, comes to us by virtue of a particular investment firm. This is Capital Group that manages the American funds. And you can see here that really in most geographies, and certainly these major geographies, the expectation is for expanding profits, which in turn should lead to perhaps some expansion in stocks and other risk-based investments. And you can see 2025 here in the U.S., company profits expanding at over 11%. That was not the case. We were certainly not expecting that as we entered the year, and absolutely not expecting it as we hit April. But nevertheless, that has been the case. So this happens to be the U.S. market proxy. Here is the S&P 500. So you can say that a fair amount of this is due to at least a few of the components of the Mag 7, including NVIDIA. But as we get more breadth in the economy, you can see here that 26 estimates are for an expansion of profits. So when you talk about a 2-year compounded annual growth rate, that's actually very strong. But the important takeaway here is it's not limited to the U.S. So you've got reasonable respected growth Japan. You've got the European zone with maybe very slight degradation, but I'd call that almost a consistent performance out of Europe that's expected. You got EM expanding there, and then China looking to build itself out of the doldrums here in 2025. So very strong expectations across the board looking into next year. Another slide kind of focusing on the global sphere here. We've got output growth looking into 2024 going to 2025 here. And you could argue here there's a little bit of degradation as we kind of get through the years here. But I'm not going to say that 2.6% output growth is going to be materially different from 2.9. It is maybe 10%, but when you get right down to it, it's solidly positive. If you saw, if you saw, notations down here in the 1 to 1.25 range, then I'd be a little bit more concerned. But this to me represents, somewhat stable output growth on a year-over-year basis. We talk about policy uncertainty, and again, we go back to April here. That was a big problem. The Trump administration, let's face it, was all over the place, and we didn't know from one day to the next, what tariff regime was going to fit with what country and what deals were being cut, and if they were even deals, and there was just a lot of uncertainty out there, and so you saw the S&P 500 take a dip, and the economic policy uncertainty crest here, and then you can see here that it's gone down, ever so slightly on a fairly consistent basis, and I think that's meaningful because the takeaway from this slide is that business confidence has improved, and I think this is just one manifestation of it in the S&P 500, where you've had just actual earnings growth, and we saw that in the last slide. I mean, 11% in the S&P 500 is something that we never would have anticipated at this juncture, when you have high uncertainty and you had an index that had sold off at least 15%. Now we'll talk about some economic data. You've got the Institute for Supply Management Services, PMI. So the PMI stands for Purchasing Managers Index. And this is the ISM's version of it. And this is services, not manufacturing. So this is important. This is, after flirtation here for a few reporting periods at the 50 line, which represents the dividing line between expansion and contraction here, we're still in the expansion phase, right, for services. You look at ISM new orders for services, those are still in the positive range. So, I mean, you see the service sector in an expansion mode. It's not robustly so, but it is nevertheless expanding. Again, probably, both fueling some of that optimism and a manifestation of it. Now we have industrial production. We've got basically a slight positive here in the latest reading. You've got up 0.1%, and if you back out motor vehicles, it was about up 0.25%. Again, not stellar, not overwhelming, but still it's positive. One thing I thought was very interesting in the pack this week was capacity utilization data that was reported from the Daily Shot here. And something that you don't look at all the time, but you can see here that capacity utilization is inherently cyclical, as it's notated here. But we have seen utilization go down. And when you think about capital spending, and it's very easy to correlate capital spending to cap utilization. So when you have high utilization, you need to spend more capital to expand your capacity in a growing environment. When the environment's not growing, you withhold that capital. And this is an environment where, oddly enough, we have been a little sluggish, but again, we're positive, and you can see some of these data points certainly negative, but offset by quite a few positive data points, but yet you still see that cap utilization continue to move down. So what this tells me is that maybe we're not going to get a lot of robust capital spending outside of the hyperscalers. Now those people are spending a lot of money, literally trillions of dollars in a relatively short period to expand data centers and whatnot. But when you get outside of that very tight box, if you will, you can see that the expectations you're not going to have a lot of cap spending that's going to buoy the economy. It's got to really come more from consumption. Okay, moving over to factory orders. This might not have been a good print from an estimate standpoint. I think the estimates were looking for 0.5% of growth in monthly factory orders, but again, it was still positive. So when we look at that, we feel a little bit better. So this is one of those that kind of went against that, economic surprise index for the hard data, but it's a rare data point for in recent memory that you had an important data point like factory orders kind of underwhelm, but still be positive here. Now we talk about apartment rents, and this is something else that is an important factor for inflation. You talk about rents and wages being the stickiest parts of the inflation picture. And again, if notwithstanding tariffs and their impact on inflation, if you just look at kind of the traditional baskets, you actually have negative apartment rent growth right now at a point where you've got increasing rates of vacancy in the multifamily sector, which itself would tend to reinforce a negative trend in rent. So right now, in the single family market, we're still at points of dislocation and points of discontent within market players, home builders and such. But at least in the rent sector, where we arguably have had some overbuilding, if you will, you're seeing that absorption kind of play itself out in rents and vacancy rates here. Now we'll talk about home purchase cancellations. This is a very interesting statistic. So these are homes that were under contract, and then when after they went under contract, they basically were canceled, and maybe earnest money was not refunded, maybe it was, but these are contracts that did not go through after they were agreed upon. And you can see that when you look over a multi-year period, that's pretty noisy. So I won't even begin to think about a line of best fit. But takeaway here is that it's moved a lot higher in a relatively short period of time here in 2025, and now sits at 15.1%, which, if you look back here, it's happened only a couple times, a few times here over the last 5 years. So this is, to me, symptomatic of a market that is still a bit in dislocation, where you've got affordability issues, even though mortgage rates have come down a little bit, but home prices have kind of moved higher. And in some markets they haven't, but some markets they have. And so this is just telling us that that there's a little bit of funkiness going on in the housing sector. Now we'll switch gears here and talk about credit. So as we were talking about several months ago, that we were wondering and speculating whether we might have seen a peak in some of the credit issues that were kind of important to the cycle. And again, going back in history, you can see, right here is a good example in 2016, 2017, where we had a false positive, and we did not have, as these gray bars would indicate, we did not have a recession. When you see this rise, you would typically think, okay, maybe you're either in recession or you're already heading into it when you have these kinds of default rates move higher. And of course, this is the global financial crisis, and that was a rather traumatic period of time for a lot of people. And then here's the pandemic. But we did have a rise in default rates in loans, and high yield bonds. Oddly enough, credit spreads were real tight. We'll talk about that in just a second. Have moved up a little bit, but again, we're seeing this, begin to tail down, which is very positive. Again, hard data that's feeding into optimism, which is feeding into expectations moving higher. Now we'll talk about the option adjusted spreads, and this is just, essentially a proxy, if you will, for the difference in yields that you get with high yield or lower credit worthiness bonds relative to the U.S. Treasury counterparts. And you can see that that's pretty tight. It's, you go back, as recently as January of last year, and even beyond, you can see periods where the spreads were a lot higher. And so this indicates to me that there's a reasonable and increasing, because it's moving lower, an increasing level of confidence here in this economy. And I know it sounds like I talk out of both sides of my mouth sometimes, because And I really try to paint a uniform picture because there is data out there, particularly in the labor side, that it doesn't necessarily support the growth story that I've been talking about. No, but there's a lot of data that is, and certainly you look at sentiment and the K economy and the fact that you've got lower income cohorts that are not doing as well. They're feeling the inflation. They're feeling beef prices at the store, and they're feeling a lot of commodity based inflation, because they don't have as much discretionary income to spend at retail stores and things like that. But the preponderance of data heading into 2026 kind of it helps to reinforce the notion of why spreads are tightening up, while why perceived risk is going down. Here we have daily job postings, as I mentioned. Overall, if we look over a longer period of time, that we've seen kind of a continued, moderation in the labor market. But again, Apollo's making a case here that the last moves have been higher. Again, I don't want to paint a picture because you've seen some notable increases on a very short-term basis, so I don't get carried away with this. But again, job market looks like it's in a little bit of a decline here. So we've got another slide here on the labor market. This is the ADP private employment by size. And what's notable in this chart, again, we're talking about some labor market erosion, so that's no surprise here. But where it's coming from is somewhat unique in the sense that you're seeing small businesses, go, contract, and we even saw this in, I believe it was last week's chart pack, where we had a rise in small business bankruptcies, and so that's certainly a case here. So, I think it is important to monitor, the health of small business. I mean, small business runs America. You can clearly see that there's more caution on the part of small businesses, either, a combination of not hiring but not firing, or, in this case, maybe a little bit of, actual cutting of positions to stay lean in the environment. But, I think this was something that was, worth notating here as it pertains to the overall labor market, as companies are trying to maintain margins. They're trying to introduce more productivity. Again, I wouldn't say that this has much to do with AI or anything like that. I think it just represents the fact that, for several months now, we've seen some caution be reflected in the labor markets. Now we'll shift and look at some investor sentiment data here. We've got the American Association of Individual Investors, AAII. This is a sentiment indicator, so this is one of those soft indicators, but not from an economic perspective, but from an investment perspective. You can see more people are bullish, less people are bearish, and you've got the net indicator showing a positive reading after a whole cornucopia here of negative readings, interrupted by a few little pockets of positivity. This is probably the most robust reading that we've seen since really the beginning of the year. And so you think about how resoundingly different these numbers are in a relatively short period of time, kind of speaks to how volatility plays on the psyche. But right now, sentiment is very good and is continuing to help propel the markets. I alluded to this slide earlier in the presentation. It just kind of looks at different ownership trends by net worth. And so when you think about the ultra rich here, you've got people that are over $1 billion. The overwhelming majority of their assets are tied up in businesses or in the stock market. And the same goes here for this cohort. But when you get down into these layers, you have particularly down in the lowest tiers, and say like people with $1 million of net worth, is they're certainly not paupers by any stretch, but you can see here that they tend to own most of their assets in their primary residence. They also have vehicles, and they have some mutual funds, and They have some 401ks here, which represents all this gray area. But as you get into the wealthier tiers here, right, you can see where there's an increasing dominance of not only real estate, but stocks and business interests that help to give them more liquidity. Because obviously these items here, when you talk about vehicles and homes, these are not liquid. And so, when you have maybe opportunities present themselves in the investment markets, or at least the perception of that by the people that are in these buckets, they're just simply not able to respond because they don't have the liquidity to jump into the market. This chart kind of dovetails with the other chart that I showed you regarding economic growth. And so this is kind of a amalgamation of different equity indices. And this is going back all the way to 1870, which is what that GDP chart did. And I should probably put those side by side to show the relevance of economic growth to stock market growth over time. And it may not feel like it sometimes when you're in the moment, but over time they correlate extremely well. And you can see here that just owing to the power of long-term diversification and long-term persistency. And you can see that this line of best fit, does work really well. And maybe it's got a little bit of a bend curve, and we've had a little bit more acceleration lately. And again, this not without hiccups. The Great Depression. You've got the tech recession and the tech bubble bursting, and you had pets.com, and you have all the froth here. And then you've got the global financial crisis that came, years later. And of course, we all remember how bad that made us feel as investors to see this kind of retrenching. But yeah, the long-term story is exceptionally powerful. And not that, we're all going to live for, basically, 175 years or 150 years here. But again, if you have the persistency and you have a long-term horizon, these things tend to always work themselves out. This slide is really a manifestation of what I was talking about earlier in the sense of optimism bleeding into earnings expectations. And I think this slide in particular has some meaning to it. So you talk about like the S&P 500 optimism and how it's channeling into increased earnings guidance. You tend to think, okay, well, this must be the Mag 7. Well, it's actually not. When you look at this right here, I mean, you've got basically about 35 to 40% of the indexes raising their earnings guidance. And so this is clearly not a very narrow phenomenon. And so you can tell it was up significantly from just a relatively short time ago. So anytime you see increasing breadth in the optimism of the index, it does send a more sustainable type signal to the trend that you're witnessing, which right now is obviously up in the market. And so there's a lot more optimism in the market than we've seen earlier. This is helping to add fuel to price appreciation for shares. And again, it's not a forever thing, and obviously this is going to have to this is going to settle out at some point. And this data series goes back to 2011, so you can see that you've had periods of very broad based participation on earnings guidance increases, and you also had plenty of periods where you've not had that, or that you have had it, and so markets do change, and but this is something that is sending a pretty strong signal out there right now. And of course, partly as a result of the increased earnings guidance, you have analysts that are increasing their expectations for where the S&P 500 is going to wind up. This going back to April and the recovery that we've had since then. Obviously, this is very powerful, very satisfying, to the psyche, right, to see this kind of upward mobility. And you've got all these different firms here that have varying degrees of optimism on where the market's going to go as a result of the increase in the earnings guidance. And again, as we talked about earlier, market seems to expect around 11% earnings growth this year and 14% next year. And if you had no change in price to earnings multiples, then that would seem to imply that you get a 14% improvement in equity shares next year. And again, well, time will certainly tell, and there's a lot of things that can happen between now and then, and not necessarily all of them are good. But right now, as it stands heading into the year, you've got a pretty optimistic band of estimates out there on the part of major Wall Street firms. Here we have valuations. Again, as I was alluding to before, I'd say valuations here in the U.S. Are looking a little bit frothy. Again, some of that's influenced by the real top-heavy nature of the index. Again, the S&P 500 today is not your father, it's certainly not your grandfather's index. And here you have the 10-year price to earnings range. And then here's the current PE, which is at the upper end of that boundary. And then you've got the average that, in all of these cases sits right in the middle here. But you can see Japan, a little bit, overvalued relative to its 10-year average PE, but certainly well within the band, the range, as is the U.S., but clearly at the top end of it. But when you get outside of those markets, then you see a lot more equitable valuations relative to the 10-year average. When you go to basically the all country world index at the ACWI, and you back out the U.S. in that, then again, these multiples in aggregate are a lot cheaper, right, than the U.S. market at like 23 times earnings. So the aggregate multiples in the rest of the world are lower, but they're also net closer to their long-term averages. And if you recall what we saw in the slide earlier about estimated growth rates, I mean, you saw a tremendous growth rate expected for emerging markets at a time where their current valuation is really not out of line necessarily with the long-term average. And Europe has had a good year itself, and so those valuations are not out of line. And so I think an argument can be made within the context of international and multi global or global diversification that some of these markets are relatively attractive to the U.S., which has this higher overall multiple and higher relative multiple. So now we'll switch to gold against the commodity basket. You can see here, volatility has certainly been high on the gold side. This is realized volatility, really outside of its high volatility band. And, and this volatility has been on net positive because we've seen a tremendous growth rate in gold. This is, only a few times in history have we seen something of this magnitude. And certainly as it relates relative to the rest of the commodity basket. So this is the equal weighted commodity index. And again, we've talked a lot recently about, some of the key elements of the commodity basket, like beef prices have come down, and other areas are maybe a little bit sticky. Corn, maybe a little bit stickier, but gold is clearly kind of decoupled. Even if you could argue in this trend line here, going back to 1995, that there's probably a reasonable correlation of commodities and gold, but that has definitely not played out here recently. So another chart I find really interesting is the supply of treasuries out there. And of course, we're dealing with very strong deficits and deficit spending. And when you talk about we were talking about the OBBBA earlier in the call, and how it's adding stimulus without really care for the long-term fiscal impact, because we are having to run some deficits, and to fund those deficits, we need to issue more treasuries. And oddly enough, we have a lot of foreign direct investment, which I was very surprised sustained itself even after the tariff tantrum that we saw in April. But you can see the meteoric rise in treasury issuance. We've got $30 trillion of treasuries outstanding at a time where the Chinese are not owning as many treasuries. And again, they're one of the countries that's shifting more of their reserves to gold, which is one reason why we've seen gold spike. But you've got other countries that don't own as many treasuries as they did. So you obviously have to find homes for all of this incremental supply. And an increasing amount of this treasury outstanding is at the short end of the maturity curve, like T-bills, which is a little problematic if you have a period of rising rates and your refunding is more expensive. But the story here is that you've got an increase, a dramatic increase in supply. And this is the classic supply and demand issue, which I think is going to play itself out in the interest rate markets. If you have increased supply, right, then that tends to drive your prices down, which then in turn helps to keep your rates higher. So those are the relationships that are important here, that I think this increase in supply helps to keep interest rates a little bit higher than they otherwise would be in a vacuum with steady state issuance. Now we have a chart related on real estate transactions. You can see here unremarkably positive, yet positive in the face of two resoundingly negative years. So again, this is, you take the small victories when you can get them. We had a long period of really outsized performance in the deal market for U.S. real estate. That obviously reversed, and it looks like it's now on the mend. Hopefully, we're getting closer to achieving some of that real absorption that has to take place, particularly in some of the more stressed areas like office. But net positive here in the sense that the expectation exiting the year is that you're going to have a positive trend in real estate deals. Last chart here we'll talk about is the private lending market, and I found this fairly remarkable in the sense that you've got a lot of competition out there. You've got a lot of money that's looking for deals, and you have more private lenders out there in the market looking to put together funds and things like that. And in fact, I had a conference call with somebody yesterday that does private lending, it's just one of the many folks that are finding value out there in providing liquidity in the non-bank sector to middle market companies in America. So what this is showing you here is that over time you're seeing the margins to those lenders are falling, and what that means is that they're having to be much more competitive on their pricing, which means that they're not making as much money as they would. And so this is very symptomatic, going all the way back to 23 here, that the market is becoming much more competitive. And so you see the size of the private credit market, private lending market exploding relative to the overall banking sector. And this is just one more chart in support of that trend. That's all we have for the chart pack this week. Hope you've enjoyed it. Have a great week, and we'll talk to you again very, very soon.